So as we did with our service company, we still need to do some adjusting entries and then close the entries. There we go. So here is kind of showing two accounting periods back to back so that you can see how we've got merchandise that we have available for sale. Some of it we sell, which goes to the income statement. Some of it we don't sell. And then what we don't sell this month becomes next month's beginning inventory. We note the balance of the what remains in inventory on our balance sheet. Next month rolls around, we might buy some additional stuff, and the whole cycle continues. Now, sometimes we go out and we count merchandise, and we realize that perhaps there isn't as much there as we thought. It walked out the door, whatever it is, there's just not there what we thought there was. We're going to write that off to make sure that our inventory balance is accurate. So what we're going to do is we're going to enter a credit to reduce our merchandise inventory by the amount we're missing. And then the debit is going to go to cost of goods sold. And then just as we did with the service company, we are now ready to do our closing entries. We are going to use that income summary account that we used the first time. And then, so we're still going to close our revenue. We're still going to close our expenses, but we're also going to close the sales discounts, sales returns and allowances, and cost of goods sold, because we want to start these over at zero. That's not going to be part of our running total. So basically, all of these income statement accounts, including sales discounts, we had all of these expenses were part of the closing entries when we did that a couple of chapters ago, or last chapter, whatever. But now we're also going to include the discounts, the returns and allowances, and the cost of goods sold. So those will all end up on the income statement, and then those get closed to the owner's capital account, as does the withdrawals, which we haven't talked about this time, but the withdrawals go into the owner's capital account as well. So this is kind of just a snapshot at the entries that you will make if you are on the side of purchasing it, or the sales side of it, and the journal entries, the debits and the credits. So this is your purchasing stuff that you're going to turn around and sell, and then this is assuming the freight is FOB shipping point. So then that goes into your cost of your merchandise inventory, any discounts, and I won't continue to walk you down this because I think it's probably pretty self-explanatory if you follow the examples and just check out the journal entries. So again, the adjustments are going to, for the perpetual system, we only really need to make an adjustment for inventory purposes if we find that our actual inventory that we have in the warehouse differs from the inventory account that we've been keeping, because remember, with every transaction we're actually crediting the inventory and reducing it. So we should have a real-time pretty good count, but sometimes you go out there and you discover that things in real life aren't the way they are in paper, and you've got to make that adjustment to ensure that our records match up with what's actually in our inventory. Because, you know, nothing's worse than having a customer call and say, you know, do I have 2 or 3 of whatever, and, you know, if you've ever bought something or looked online and saw that a store had a few of things, left, and then you get over there and you find that in fact they don't. And that's because they didn't update their inventory, their online inventory records to match the physical inventory count. So we do our adjusting entries to make sure that the physical count matches our records, and then we do our closing entries. So our sales go into income summary, and then all our expenses plus the new expenses that we've, new income statement accounts that we've added, the cost of goods sold, sales discounts, returns, all of that also goes in to income summary. And then those will get closed into owner's capital. We prepare either a multi-step or single-step income statement, depending on your preference. This is a multi-step. So we start here with sales, then we have our discounts, net sales, cost of goods sold, we get to our gross profit, and then we roll right into our operating expenses, and then we've got other revenue and expenses, and then we get to our net income at the bottom. That is the multi-step. So we've got several steps along the way. With our single step, we start with net sales. We basically have all of our revenue sources at the top, and then at the bottom we don't have a separate subtract out of the cost of goods sold before we get to our expenses. Nope, we just lump cost of goods sold in with the rest of the expenses, and we subtract all of that, all of the expenses from all of the revenue to then end up with our net income. So it's just really two different presentations of the same concept. We still end up with the same net income in the end. Our classified balance sheet will include merchandise inventory, no different than the classified balance sheet that we had done with the service company, with the exception of the inclusion of that merchandise inventory account. And I guess we'll cover acid test and gross margin ratio. So the acid test ratio is very similar to the current ratio that we learned about last month. But instead of looking at all current assets over current liabilities, we just look at what are called quick assets. And how do quick assets differ from current assets? Well, so these two are the same equation. The only difference is that we've broken out quick assets into its various pieces. Essentially, you're still using your current assets in this, except you're not going to use inventory. So while inventory is a current asset, it will not show up in the numerator of your acid test ratio. It will show up in your current ratio, but not in your acid test ratio. And so here again is the equation, and then we show the acid test versus the current ratio. So again, basically the only difference between the acid test ratio and the current ratio is the acid test ratio is not going to include inventory in the numerator. But then you can compare these across industries, across time, and figure out the health of a company. Basically, what, if they needed to pay their current liabilities tomorrow, what could they get their hands on without actually having to make sales, is what that acid test ratio tells you. And then the gross margin ratio is our net sales minus our cost of goods sold over the net sales. Remember, the net sales are our sales less our returns and allowances. And so that gets us to net sales. We then subtract cost of goods sold from that and then divide that by net sales. So our gross margin ratio, pretty self-explanatory, I think, and it's obviously stated in percentage. So I'm going to stop here, and I'm going to talk about the periodic system on the next slide.